Hi everyone, welcome back to Financially Frugal. Today I'm here to go through, well, it's a little bit different video than what I've normally got. So I've done a lot of talking on this channel of what I would consider the frugally side of things. So that's with the sale papers and grocery hauls, talking about how much things that are on a good deal, things that are priced well, um, items that I got that I consider a good deal. So that's all what I consider the frugally side, and all of that will continue going forward. But I kind of wanted to come on here and start, applying some of the financial side of things. So what I'm going to talk about today is my IRA account. So it's on M1 Finance, and I'll leave a link below down to where you can sign up for an investment account. M1 Finance is a good platform uh, if you want to start investing in the stock market. They offer regular, individual, taxable um, investment accounts. They offer traditional IRAs where the money that you put in, you can, if it's not, you can either put in pre-tax dollars, or the money that you put in, if it's after taxes, you can claim that as a credit on your tax return. But then any money that you take out on retirement, you'll pay taxes on that. Or they also have what I consider to be my favorite is a Roth IRA, where it's kind of the opposite of a traditional IRA, where you can contribute uh, up to $6,000 a year, and all of that you put in is after tax money. So, I get my paycheck from working, and my taxes and everything are taken out of it, and then the money that I put in comes from my net pay that I get for working. And the good thing about that is, as it continues to grow in the stock market, it grows tax free. So if you can get started, in your 20s or in your 30s, and start, putting as much as you can into the account up to that $6,000 a year threshold, all of that will grow tax free. And then when you are 59 and a half, you can start withdrawing from the account, and all the money that you made in that account, which hopefully over the span of 25, 30, 35, 40 years, you'll be able to make a nice return on that investment. And all that money that you made is going to be tax free. So you won't have to pay taxes on it when you take it out. So just kind of going through a few of the things here. I started this account back on May 9th, 2019. So it's been going almost a year, and I've contributed about, almost in total between last year and this year, almost $6,000. So I've contributed, um, right here's the value that I've contributed, $59.83. But with coronavirus, COVID, it's given the stock market quite a beating here, and I've actually lost a pretty good bit. But I don't really consider this um, a loss. So what my account, I consider it, because it's this value here counts your dividends, so I consider it to actually be down this value right here, $825.50. But I don't personally, in my mind, consider that a loss, because I haven't sold anything, and I don't plan to sell anything. I still have the shares of the company. So in my mind, the only way that I lose is if I invest in a company that, goes bankrupt, or something like that. And I, you know, try to combat that the best I can by investing in good companies that I know. And I'll probably do a video that goes a little more into depth about that, because this is just kind of a general overview of my account. So, but I invest in things like Disney, Microsoft, McDonald's, Walmart, a few real estate investment trusts, which can be a little more risky, but to me it's worth the payoff. But several companies kind of like that I don't foresee them going anywhere anytime soon. So yes, their share prices may be down. They may lower their dividend payments, but I still have the shares. And it gives me the opportunity while the market's down to be able to go in there, and when I make a deposit into my account, it lets me get more for my money, because if the share price for, let's say Disney is down 20%, that means I get kind of, it's probably fuzzy math here, but get 20% more for my money, because I can take the same, $50 or $100 or $200 that I'm depositing and buy more for that amount of money. If that makes any sense. All right, so just I'm just going to do a quick overview today. So, where I stand right now, the value of my account is $5,104.33. Going from the time that the account was started until today, the market gain is down $825.50, but I have earned dividends of $130.10. So I like to invest in companies that are, first of all, good companies that I believe in, that also will, fingers crossed, if everything goes well, pay me a dividend. And I think, if I remember right, there's only two companies that are in my portfolio that don't pay a dividend. And I just have those just for the growth potential. Um, but overall, for all the companies that have been paying dividends in my account, I've made $130.10. So the way M1 Finance does it is they accumulate your market gains and your earned dividends to give you your gain here. So yes, my portfolio is down about 21%, but in my mind, I see this as a good time to buy, to get in there, to keep averaging down the cost per share that I've paid for these companies for their shares, and just get in there, buy more, drive the average down for what I've paid per share, and then just sit on them for the next, you know, 25, 30 years until I'm able to retire. And then hopefully, my hope is that come around that time, I'll have enough in the account to where dividends hopefully will give me a nice nest egg, and I won't have to pull from any of the, what I call the principal of the money that I put in, the actual money that I invested. I'm hoping that I can let that sit there and continue to grow, and just pull out what I make in dividends to either supplement other income, or, what would be really nice is to be my income. Um, so anyway, all time I'm down 21%. Let's check today. I know today was kind of a hard day. So it was down, that out of that $650. What was it again? Let's see. $695.40. Uh, Today, $101.86 was lost, which is counted into that figure that you saw before. So it's down about 2%. Again, I'm not worried about it, because, I'll put more money in. I'll keep buying and sitting on those shares and let it come up um, over the next lots of years. So down for the week, I'm down about $300 and change. So that's about 5.7%. The month is actually better, because we had a big dip a few weeks ago where just lots of days it was just going down, down, down. Um, and my account went way down. I believe it was losses of um, over $1,000 in my account. I don't remember the percentage, but most people look at that and they start freaking out about it. But again, I don't consider that a loss unless I actually sell the shares. Because I still have the shares. They're still there in my account, and I just gotta hang on to them until they start back appreciating in value again. So then, after a few weeks of going down, things started kind of an uptick. So we actually are up 14% for the month. So yeah, then the year and the quarter, or the year and the all are the same, just because my account's not more than a year old yet. It's almost a year old. So yeah, that's all I wanted to do today. Just kind of talk about Roth IRAs a little bit, talk about kind of why I'm invested in one, and just kind of my strategy for just while the market's down, just putting in as much as I can and investing in good companies that hopefully pay a dividend, and just sit back and collect that money, keep taking these dividends as they're paid, investing them back into the portfolio, and hopefully, 25 years from now, I'll have a nice chunk of money to to supplement retirement income. Right, so that's all for today. Uh, Hopefully you like this video. It's a little bit different. I'm going to try to kind of report back every now and then, maybe once a week or so at least, about how the Roth IRA is doing, because I want to get some more financial advice and into this. So yeah, hopefully you'll have that to look forward to. Can't wait to kind of get on here, talk about some of the companies that I'm invested in, why I'm invested in them, things like that, and kind of go through when I do my buys, and just kind of talk about, what I'm buying, much I'm paying for it, and things like that. So once again, if you haven't already, make sure you click the subscribe button below this video. Also ring the bell icon so you'll be notified every time a new video is uploaded. Also, leave a comment down below, and let me know if you have a Roth IRA, or if you're doing any kind of retirement investing. And if you are, what platform are you using? It could be M1 Finance, it could be Robinhood, um, Webull. There's lots of free platforms out there, and then there's some of the big daddy ones that have been around for a long time, like Merrill Edge and Fidelity, those kind of platforms too. So, if you have a reason that you picked a certain one, let me know what that is down in the comments below. Because M1 Finance is good for me, but that doesn't mean it's good for everybody else. And there's certain things that other people want that they're looking for, and there's pros and cons to each platform. So, you know, what's good for me may not be as good for you. So, uh, let's leave a lot of comments down below, and so we can help anybody that's new into this kind of get in there and help them start investing. And hopefully, we all make a good chunk of money together. So that's all for today. Make sure that you subscribe, ring the bell icon, leave a comment down below, share this video, and also drop a like on this video too to help that YouTube algorithm. So that's all for today. Make sure you like, comment, subscribe, share this video. Stay healthy out there, and we'll see you next time. Bye for now.